I don't know, well, it's exciting to be here with you, Dom.
Yes,
so
I'm
there's
excited.
that. But in terms of the markets, I think we're going to chop around. Maybe between now and the end of the month, we can continue to rally because we're getting through earnings and we don't get any inflation data. But then you have September that comes, and you do have a lot more inflation, and then you have the Fed meeting. I am encouraged that the economic data is not falling apart, which is a good thing, right? I mean, if you look at industrial production today, it was double expectations, and capacity utilization was up over 80 for the fourth straight month, so that's good. Manufacturing seems to be holding up. It's housing that's not, right? And it's inflation on top of that. And so as long as we have inflation and high inflation, we're going to have to deal with the Fed. And so I think September kind of gets dicey.
So Josh, I mean, valuation-wise, we've made this kind of case before that valuations were a concern. They don't appear to be as much of a concern anymore. Now, they can say that earnings expectations are doing better than they have, right? We have seen earnings come in better. Is this then a sign that maybe the fundamentals do justify a market that can continue to head higher?
It's a great question, Dom. I really don't think fundamentals are the problem, and I don't think, valuations are the problem. And I don't think valuation really has been an issue for most of the market. We had a few pockets of the market where valuations a year ago were ridiculous, but most of that has cured itself. So the bigger issue, I think, right now, if you think about the things that have driven the rally off the lows, the bigger issue is how many of those things are sustainable or will stick around long enough to support the values that we have, or the levels of the market that we have now. So what are those things? Well, the stock market very much likes falling oil, falling gas prices, falling gasoline prices, most importantly. And we've had that. We've had like 60 days of declining prices at the pump. Very notable decline, too. Not just a little bit off the highs, but very much off the highs. And in fact, you see WTI crude today down another 3%. 86 and change. That is the lowest that we've seen since January. That predates the invasion of Ukraine. That's been important. The second thing, falling interest rates. For some bizarre reason, the Fed is dropping 75 basis point rate hikes like it's going out of style, and financial conditions are actually easing. I would argue this works against the Fed's larger goal and is not a great thing in the intermediate term, but it's been helpful in the short term. The street likes lower rates. That's why you see this rally being led by the high multiple, high growth crowd. And then the last thing that we've had is still a lot of liquidity and a lot of support. Even though we've had rate hikes, we've had a lot of liquidity in the fixed income markets. In September, that part of the story changes. And I've been talking about this, and I don't think enough people are talking about this. We are going to have a ratcheting up of quantitative tightening, regardless of what's gone on with the 10-year, regardless of what's gone on with earnings or any of that. And I don't know that this market can handle that big of a change in financial conditions coming from the Fed itself. So we're going to have to see. But I think you've got to continue to give the benefit of the doubt for the bulls in the very short term. But September is right around the corner.
So Jason Snipe, it's interesting. By the way, we're going to have a lot more of that energy and oil trade later on in the show, because we want to dive into whether or not that's driving a lot of the market activity that we've been seeing. But Jason, it's interesting. We're talking about all of this and this market rally on a day when retail earnings really are kicking off in earnest, and we got a decent look from two of the arguably best bellwethers in the American retail business, and that's Walmart and Home Depot. I wonder, though, Jason, if either of those reports have done anything to change your view of the markets overall. Do we think that this is still constructive, given the consumer outlook we got from both of those retail giants this morning?
It's a great question, Dom. And obviously, Josh and Steph have cited a lot of the macro data that I think has been supportive of this market. We looked to inflation last week, PPI and CPI coming in a little lower than expected. And I think what's the important point that Josh just mentioned is QT is starting in earnest in September. But to your question, Dom, on retail earnings, obviously Walmart cut their guide a couple weeks back. The numbers were solid. I mean, it's just retracing the number previously that they had cut from is really where they arrived at. Revenue growth was up about 8.5%, which is solid. And I think Home Depot, I mean, we've talked about the housing trade a lot, the housing adjacent trade. Home Depot was solid. I mean, revenue beat, EPS beat, The pro numbers are pretty solid. So I think the consumer is in a decent place. I don't think they're doing great, but I don't think they're doing as poorly as we've all talked about over the last couple of months.